Why is the stock market taking off? Why are stocks suddenly surging? Well, we have an answer for you. It could have to do with the debt ceiling. Hey, everyone, welcome in to the Investing in Real Estate show, where we hope to make you a more intelligent investor on this show. So you might be looking at the stock market and saying, well, what in the world is going on here? Why is it surging right now? Well, when you have the debt ceiling that has just been removed from the playing field, like we're not going to hit this debt ceiling anymore. We've now just, it's wide open, blue skies. That's free money, right? And that's why these Wall Street companies are getting richer. So all these Wall Street companies getting richer, and people who are buying into these companies are making money. But America, of course, is suffering big time. I mean, we're seeing the devaluing of the US dollar. So you can allow the national debt to continue to rise. We just hit over $32 trillion in national debt for the United States. It's unbelievable, unbelievable. And now we know that the debt payments alone are going to exceed, or the interest payments alone on that debt are going to exceed $1 trillion. I mean, it's absolutely unsustainable. And then, of course, you have all of these other nations that are joining up with the BRICS nations right now, Brazil, Russia, India, China, South Africa. And you have all of these countries that want to be a part of what BRICS has to offer. And in August, they're having the big BRICS summit. A number of other countries have now come forward saying, we want to join you guys instead of the US dollar. Italy was probably the biggest announcement over the past week, announcing that, yes, we want to start settling transactions in the ruble, in the Russian ruble, not the US dollar. Here's a US ally in Europe saying, we're done with the US dollar. I think we're going to move away from that, move towards a country and a conglomerate of countries, the BRICS nations, that have a currency backed by gold, backed by silver, backed by actual commodities. So when you look at what's going on in the stock market right now and you see these surging stocks, you have to sit back and say, well, why? Right? Well, Congress has removed this artificial debt ceiling that they were never going to hit anyway. No one ever believed they were going to hit this debt ceiling and default on our debts, right? If the United States defaults in that way, it's game over. So they weren't going to do that. They're just going to pull the governor off of it now and allow more money to be printed. When you remove that debt ceiling, that's exactly why things are running away. But guys, I want you to really pay attention to what's going to happen here at the end of the summer at this big BRICS summit. We are watching 2023 as perhaps the most pivotal year in America's monetary history. We had a good long run of it, good long run of 50 years of US dollar dominance. We are now seeing the flip. We are now seeing the tipping point. We're seeing these countries wanting to move completely away from the US dollar, settle oil transactions in the Chinese yuan, Russian ruble, your own government's currency, and move away from this. I mean, just look at India, for crying out loud. India has been pulled by both sides, and we see where their loyalties are. No amount of the head of India coming to the United States and doing yoga last week is going to change any of that. So we are watching this very, very closely. But again, if you're seeing the stock market and you're saying, maybe I should just throw a ton of money into this, be very, very careful. Make sure, like I invest in a few stocks, but they're backed by actual commodities. These are companies that are pulling actual minerals out of the ground. These are commodities companies, right? That's who I have a small portfolio. That's it. But the bulk of my investing is in real estate, and it's in gold, it's in silver, it's in tangible assets. And so I can't tell you where to put your money or how to spend your money. Seek the advice, of your financial advisors on this, but hope that they don't tell you to throw tons of money into the stock market, because I would be very, very careful as to what's happening right now with all of this artificial money and the propping up of Wall Street right now. So today is our Q&A episode. We're going to get to your questions here. We've got 3 great questions from investors who have some questions about investing. We're going to answer those questions, and you can always leave us a voicemail message if you'd like to by going to our website. Go to morrisinvest.com, click on the microphone icon on the right side of your screen, and leave us a voicemail question about whatever it is, any kind of investing you want, anything you're struggling with. Ask your questions, and we will answer it here on the show. So we will get to 3 great questions here in a moment. But first, I want to tell you about our friends at Lear Capital, because Natalie and I are big investors in precious metals. Yes, we invest in real estate, but a big portion of our portfolio are in precious metals, gold and silver, because of what's happening to the US dollar. It's no secret, if you're tuned in, then you need to know that experts are predicting a big recession headed our way. One economist just said, this is the beginning of the end for the US dollar. So if your savings accounts are tied to the US dollar, look out, folks. Please, please protect yourselves. And we are devaluing the US dollar faster than ever before. And last year was terrible for most investors, but 2023, 2024 could even be worse unless you're smart and you have a portion of your assets in precious metals, other hard assets like gold, silver, and real estate. And that way you can protect your financial future as these other investments start to collapse all around other people. So if you want to invest in gold, our friends at Lear Capital can get you set up and start purchasing precious metals right now, or even converting part of your IRA or your 401k into a gold and silver IRA. It's very, very simple to do. And you can call them. They love talking to people on the phone, so you can see if it's a fit for you. Give them a call today at 1-800-450-1008. There's the number on your screen. We've also set up a special website just for you as well. You can get your free gold and silver investor guide by going to learmorris.com. That's LEARMORRIS.com. And right now, if you call and work with them, they'll get you set up with $15,000 in free bonus metals. That's right, $15,000 in free bonus metals with a qualified purchase. Again, call their 800 number today, 1-800-450-1008. And you can buy gold bars, gold coins sent right to your home, silver coins, silver bars sent right to your home, or held in storage off-site. They will talk you through that entire process. Again, give them a call today, 1-800-450-1008. Okay, let's get to your real estate questions or your investing questions. And our first question comes to us from Jeff.
Hi, Clayton. It's Jeff. Love your show, Redacted. It's awesome. And I was wondering, I would like to do a self-directed IRA to invest in real estate eventually. I don't know if I should do it in a Roth or a traditional IRA. Please let me know. Thanks so much. Have a great day.
Hey, thanks, Jeff. Great question. So again, I can't tell you how to spend your money or how to structure your self-directed account. Personally, I converted mine years ago from a traditional IRA to a Roth IRA. Now, what's the difference? Well, the biggest difference between a Roth and a traditional is when you pay taxes. That's it. That's really the only difference, when you pay taxes. So with a Roth, those are funded with after-tax monies. So you've already paid the taxes on it. You've made your money from your job, wherever you got this money. You've already paid Uncle Sam the taxes. And what's left over is what you're investing in this Roth IRA. Now, the beauty of the Roth IRA is that you've already paid the taxes. Now, I don't know about you, Jeff, but I want to retire in a higher tax bracket. Right? I want to be in the higher tax bracket when I retire, meaning wealthier. So the fact that I've already paid the taxes on it now allows it to grow tax-free. So if you invest in real estate inside of a self-directed Roth IRA, and the tenant money is coming into that account, you can't touch it. You can't touch it till you retire, 59 and a half years old, right? You don't touch it. But the appreciation of that property, the wealth of the tenant money coming into that property, into your account, is all growing tax-free, so that when you retire, you can access that account and not pay any taxes on the investments of real estate in that account. That's what I do personally. That's what Natalie and I do together, is we use a Roth self-directed IRA to invest in real estate. Okay. A traditional means that you're paying taxes later. So, okay, great. Now you can mitigate your taxes now, right? You can defer it. You can defer paying taxes until later. And then you take that money out later, but you're going to then pay taxes on it then. And the reason I'm not a fan of that is because, again, I want to retire wealthier. right? So I'm going to be in a higher tax bracket in 30 years, ideally, and therefore I would be paying more taxes then than I would now. So why not, in my opinion, again, in my opinion, pay the taxes now in a lower tax bracket than I get to enjoy the benefits of not paying taxes later? So this is one of the great things Tom Wheelwright loves to talk about this with the 401k plan, right? When people use that as an argument. Yeah, it's great because you're deferring the taxes. You don't have to pay any taxes now. Great. So if you're like a 23-year-old, 24-year-old and you have a 401k, chances are you're in a very low tax bracket. You're not very wealthy when you're 24, 25, 30 years old, whatever, right? The idea is that great, you're not paying taxes now. You're going to pay taxes eventually, and then you're going to be in a higher tax bracket, so you'll pay more taxes later on. So that's my opinion. I'm a bigger fan of the Roth structure for self-direction. That's my personal opinion. Thank you, Jeff. All right, next question.
Hi, Clayton. My name's James from Minnesota. I have about $35,000 cash, and I could continue leasing a vehicle that's about 25, and some renovations that I want to do in my condo. But if you had $35,000 cash, would you continue to lease a vehicle? And then how would you put that amount of money to work? Thanks.
Okay, great question. Thank you. I would say number one, a couple of things here. If you've got money sitting in US dollars right now, personally, I would want to move that into something that's going to be protected against inflation, a hedge against inflation. Because right now, that $35,000 day after day after day is losing value if you've got it in a savings account. Okay, so think about, can I convert some of that into gold, into silver? Can I put some of that into real estate? Again, we at Morris Invest, we have our Connect Invest partnership that we've just teamed up with. If you go to morrisinvest.com/connect, you can take a small portion of that and start investing into real estate now, okay? As little as $500. So that's an option for people that don't have a full down payment amount to buy a piece of real estate, like an actual new construction property, which is going to be in the 50,000 range, down payment, and then you'd finance the rest. So if you've got less than that, it's an option for you. Again, just check it out and see if it's a fit for you. Or put it into something that's not tied to the US dollar. So if you put it into silver, into gold, Bank of America has a price target of gold of $3,000 an ounce. It's at about $1,900 an ounce right now. Silver also, huge price targets. Silver is at about half of its all-time high right now. So Natalie and I just bought a bunch of silver, but we also just bought real estate. So we're constantly looking at both of these things to put some of our money now out of US dollars. So that's one thing. That's just on the cash side. I wanted to address that. Now, the other question is about taking that money and sinking it into liabilities. And I could never advocate for that. Taking money and putting it into a liability, like a car or the house you live in. The house you live in is an asset. It's not a performing asset. So you're going to renovate the house you live in, but that's not buying an asset. If it needs repairs, of course you need repairs, right? But if it's, think about that for a second, right? If you could take that money and put it towards buying an actual performing asset, something that's going to produce monthly cash flow for you, I'm a much bigger fan of that than throwing money at a car, right? Putting money into an automobile is a non-performing asset. In fact, it's a liability, right? So I can't advocate for that. I own the car that I own to get around. We all have to do that, right? Or maybe public transportation if you live in a city or something. But so I have a car that's paid off. I don't pay a monthly payment on it. And I'm going to drive that thing into the ground. And I'm going to own it for many, many years. The car that my wife has is paid off. And we've owned that, I think, since like 2015 or so, 2015 or 2016. And we have no intentions of selling it. We have no intentions of buying a new car. We're going to drive that Volvo into the ground. So I'm not a fan of putting money into liabilities like that. If you've got 35,000 there that you could reposition and start to buy some assets that could produce monthly cash flow for you, would be ideal. Even if you took like 10,000 and you put it into real estate, like at Connect Invest, if you just go to our website again, morrisinvest.com/connect, and look at it, where you could be making, an 8-9% return just this year alone by buying into a real estate fund essentially for like 12 months. You set the length of time. So in that 12 months, while that money is sitting there, it's actually doing something for you. And then you can take it out after a year and make a down payment on an actual rental property or something. So just some ideas there, but I'm not a fan of sinking that money into non-performing assets, because then what do you have to show for it? Now your house is fixed up, great, but now you have no cash and no ability to start actually investing. Unless, of course, you take out a home equity loan because you've increased the value of your home asset and you take some equity out of that property to start investing it in other properties. That's what I would do personally if I'm sitting on equity. Again, thank you for the question. And I don't mean to be harsh about it. I just, especially with cars, liabilities like that just really, I hate to see you waste, pouring money into something like that, All right. Unless you're an Uber driver, then it is a performing asset, I guess. But, you're probably not. All right. Here's Michael with a question.
Hey, Clayton. Thanks for the opportunity here. My name is Mike. I just had a question for you. I currently rent one property. When I transitioned to a new property that we have mortgaged when the family grew a little bit, that current rental nets me about $1,000 a month over the mortgage. And then we also have a vacation home we purchased last year that we're just utilizing for the family. So right now I have 3 mortgages, which is a lot, obviously, and I'm looking to limit my mortgage liability while also looking to pursue new investment opportunities. I'm wondering if you have any kind of general high-level strategy for me to limit my current mortgage liability while also kind of pursuing new assets. Any feedback you have there? I know it's kind of a high-level question, but any feedback would be great. Also, I just was curious how you calculate the 18% ROI on anything you look at new. Thanks.
Thanks. Well, when we talk about our properties at Morris Invest, our new construction, we're looking at an internal rate of return, right? So what is the financing? What is the appreciation of the property? What is the cash flow of the property? And what is the tenant buy down of the mortgage, right? So we're looking at the overall internal rate of return using financing. I'd rather you use the bank's money than your own money. Why would you use all of your own money? So we use internal rate of return. Of course, ROI is going to be different, right? If you're just doing straight ROI and it's a cash purchase of a property, it's a different animal. But I prefer internal rate of return using the bank's money because, you can, why should you do it all yourself, right? The wealthiest people in the world have always used other people's money to build wealth. And that's just my opinion, but why shouldn't you do that as well? On the mortgage question, there's really no highway, to mitigate this unless you're thinking about, okay, can I pay this down more quickly using a strategy that Natalie and I outline in our book. If you go to Amazon, it's called How to Pay Off Your Mortgage in 5 Years by Natalie and Clayton Morris. I recommend getting the blue cover. That's the most updated recent edition. We're actually working on a new edition right now, but that's the most recent edition that's available. So see if that book could help you. It's a short read. It's about 100 pages, but what we lay out in there is using some of the equity position you have in addition to some of your retirement accounts to fire it at the principal balance. We give you strategies and tactics plus spreadsheets and things like that to fire at the principal balance of your mortgages to pay them down more quickly using home equity line of credit, et cetera, and other financial vehicles in order to do that. But I will say this, you have one quick way to alleviate one of these mortgages is really run the numbers on that rental property that you're making $1,000 a month on. Like, what are the taxes? What is the internal rate of return on this property right now? What are you netting every month after your expenses, after your taxes, all of it? Are you holding on to that property just for some sort of emotional reason? Because you owned it and then you moved, so there's something there. You thought, okay, this will be a good investment. It's renting for $1,000 a month, but could it be better positioned if the rate of return is not very good? Like I want, like I said, like with our properties at Morris Invest, roughly around 17-8% 17 or 18% internal rate of return. That's like our target, right? The mileage may vary a little bit, but that's what I want to basically get near. I want good cash flow, right? I want positive cash flow, and I want low taxes, and I want a great return. So if this property doesn't fit that criteria, Mike, then maybe, think about selling it, right? And then taking that cash, using it, however you structured it as a 1031 exchange, rolling that into additional, more profitable investments and get yourself out from that burden of that particular mortgage, especially if the return isn't there. Like if you're just about breaking even, which are you? Because I know $1,000 a month, like I'd be curious what the mortgage is on this, plus taxes, plus expenses, plus property management. Are you just breaking even? This is where you really want to be honest with yourself. Like really be honest with yourself, brutally honest with yourself. Run the numbers. Put all of the expenses, because a lot of times people lie to themselves. And I'm not saying you're doing this, but that's what a lot of people do. They're like, yeah, making great money. It's $1,000 a month. But they don't ever really calculate their expenses, their taxes that they're paying on this property, the property taxes and all of those things. And then they find out, oh my God, I'm literally breaking even, or I'm actually in the red. So just be brutally honest with yourself on this property. Are you losing money, breaking even? Maybe it's time to put it up for sale. Take those profits, roll it into better investments. That's one way to alleviate this mortgage pain. The other way is that what I talk about in our book is to pay it down more quickly using our strategies. Now you have this vacation home. One thing to think about is with a vacation home, a second home, is how much are you actually there? Second homes are I just had a long conversation with a friend about this because my friend's wife really, really wants them to buy a second home in another country. He is not keen on it. I've had experience with this, a lot of experience. And I had to say to them, look, here's the thing. How much are you actually going to use this property? Because if you're only going to go like 1 week or 2 weeks of the year, is it worth buying a whole house for that reason? Because you might be better off just getting a really nice apartment or a rental something near the beach that you love to go to for that week, an Airbnb or something, a bed and breakfast. But do you really need to own the home? You're only going to use it 1 or 2 weeks a year. And as the kids get older, they're not going to want to hang out all the time. They're going to want to go off and do their own thing with their friends. So then pretty much you're like, oh no, this house sits vacant all the time. We don't really ever use this house. It sounds sexy to have a second home and a second vacation home or a vacation home in general. But when you really get down to it, you got to use it, right? You got to use it all the time for it to make sense. And if not, if it's sitting there vacant, then maybe turning it into an Airbnb or renting it out. But the big problem that people don't think about with second homes is that very often you're going to want to go to that house during those great holidays, right? The July 4th holiday weekend. You're going to want to go with your family. Well, those are also the most lucrative weekends to rent it out for an Airbnb. So now you're taking off the table the very days that should be most lucrative for a rental, for a vacation property for someone, because you want to go there with your family at Christmas, spring break, 4th of July, Memorial Day, and then if you stop doing that in order to make money from an Airbnb, you're like, no, you know what? We're just going to rent it out those weekends. Then you're like, well, then why do we own this property? Because now we're not going there because we want to use it. So a lot of things to consider. A lot of things to consider with this vacation home. Maybe really structuring it so it is a rental property and you go there at certain times of the year, maybe off-peak times. Or, you really work to pay down this mortgage. The second home thing is a real tricky beast. It really, really is. And it's not a performing asset unless you turn it into one. And then you really have to think about the concessions as a family you're making with this property. Do you want to go there in off-peak times when it's not so fun and your kids are in school? So now you're taking them out of school to go there. It's not during a vacation time. So a lot of things to consider. You can see that I'm passionate about it and I've thought a lot about it and we have a lot of experience with it. So thank you. Really great questions today, guys. Thank you guys so much for your great questions. If you would like to ask us a question, go to our website, go to morrisinvest.com. Click on the microphone icon there on your screen. Check the description. We'll have links to everything we talked about today. Thanks to our friends over at Lear for supporting our show. If you'd like to pick up some gold or silver, even just a small amount, and storing it off-site in a storage facility, you can do all that. We'll have links to that in our description below. So thank you guys for the great questions. Now go out there, take action, become an investor, become a real estate investor. I believe it's the #1 way to build wealth. We'll see you next time, everyone.